you have just your traditional 401k versus the Roth. I have terrible penmanship. But in your, oh no, Bob can't see the board. That's okay though. So in your pre-tax 401k, as I mentioned before, you put in pre-tax dollars. So that means that you drop your taxable income by the amount that you contribute annually. So if this year I put $4,000 into the plan, I'm dropping my taxable income by $4,000. So I get this nice annual tax benefit. The dollars are tax deferred. So what that means, and this is a huge benefit that people forget, is that you do not pay capital gains taxes on the interest that you earn in the plan. So right now, capital gains is 15.1%. So if I had a regular taxable account on my own, if I earned 10%, out of that 10%, 15.1 would go to the government. In your 401k, in your pre-tax 401k, those are all tax deferred. So you can imagine not having to pay capital gains over 10, 20, 30 years really does add up and provides a nice benefit. Now, the government's giving you these great front-end tax benefits. They're not going to give you tax-free money. They want to tax your dollars at some point. So when you retire, you take the dollars out and they're taxed as ordinary income. So that means that when I retire, I'm not going to take out all my money at once, because if I did that, that'd be a huge taxable event and would probably put me into a different tax bracket. So what I do is every year I decide, okay, I need this amount for this year. I take that out, I pay taxes as ordinary income on the amount I take out. The reason that's important is that when you pay it as ordinary income, it's simpler than having to go back and figure out your realized capital gain. Could you imagine going back for the last 40 years and trying to figure out your realized capital gain on the dollars in your retirement plan? It would take all of retirement. So this is a simple way, pay taxes as ordinary income as you go. And again, the contribution limit for this year is $18,000, and if you're over 50, you can put an extra $6,000 in there. On the flip side, you have the Roth, and the Roth is where you contribute after-tax dollars. So I contribute the exact same way through my payroll deductions, but I do it after tax. So I'm taxed on the dollars as I put in. So I don't get that same annual tax benefit. But as long as the dollars stay in a qualified plan for a minimum of 5 years, your contribution and any interest is tax-free. So I'm putting that 5-year caveat. So you can imagine this is a huge benefit, right? If I want to hedge against tax increases, do I think it's cheaper to pay my taxes now or in 30 years when I retire? Is it cheaper to pay my taxes now in my current tax bracket or my tax bracket in 30 years when I retire? Does it make more sense to pay taxes on my contribution today? Let's say I contribute $5,000 today. I'm hoping in 30 years my $5,000 is worth 50. I'm going to hang myself, aren't I? So is it cheaper to pay my taxes now on $5,000 or in the future at a variable tax rate on $50,000? So it's something to think about. But I think most important is that it gives you the ability to manage your taxes during retirement. And young faces are probably thinking, I've never thought about managing my taxes during retirement. But it's really important because let's say all of your money is in the traditional pre-tax 401k. Every time I need money during retirement, it would be a taxable event, right? So let's say the first year of retirement, I know I'm going to need $30,000. If I take 30 from here, I'm taxed on $30,000. But I could take 15 from here and 15 from here and drop my taxable income from $30,000 down to 15. Or we see people use all their Roth money first, and then once their Roth money runs out, then they use their pre-tax and pay taxes on those dollars. So at least it gives you the ability to manage. The other, if I don't say it, I'll forget, hang on, is that you might have years where you have a windfall, where we've seen that where somebody has an inheritance and they can't touch too much of it, but they need dollars to pay some bills, and if they took money from here, because of that windfall, it would push them into a different tax bracket. So having some after-tax money really does help you manage your taxes once you retire.
Is there an adjusted gross income limit for contributing to a Roth?
No. So I know where you're going. So in a Roth IRA, there are income restrictions depending on how much you make. If you make over a certain amount, you're not eligible for a Roth IRA. Within a Roth 401k, there are no income restrictions. So it doesn't matter what your income is, you are eligible to participate.
Is there a yearly limit that you have to put in?
Yep, so you can contribute to one or the other or a combination of both. If I put in 10%, I could put 5% in both. But the total amount, they have the same 415 limit, so the total amount can't exceed 18,000. So I could put 10 grand here and 8,000 here, but together it can't exceed this limit. And of course, this limit is just your contributions. It doesn't include company contributions. The other thing to note is that it doesn't matter where you put your money, you're going to receive the company contribution. So let's say if I have 4% going in the Roth, the company's going to match the 25 cents on the dollar up to the first 4%, but their contributions are always pre-tax. And the reason for that is the IRS won't let them pay your taxes for you, right? So any company contributions from the match or the profit sharing are always pre-tax. So if you do elect to use the Roth, on the statement and on the website, there's an area that says funds by source, and you'll see where it says pre-tax contributions, after-tax contributions, match, profit sharing. It's all broken out by source so you can see exactly where those dollars have come from.
Say the Roth is tax-free after 5 years. What if you take it out before 5 years, some of it?
Then you have to true up the
So
taxes on
you're
it.
getting double tax on it.
Yeah.
And is the 5 years, say you put $1,000 in this year, can you only take $1,000 6 years from now, or you can
Nope.
take any of it 6 years?
Yeah, so basically it's not like a rolling clock where I put in $1,000 today and that $1,000 is eligible in 5 years. Once you make your very first contribution, it gets the 5 years going. Anything after that uses that first contribution as a date. Yeah. But it really is something that is more geared to investors who have at least 10 years to retirement. And the reason for that is that you really need that 10 years in order to make up for paying the taxes on the front end. If you're not sure if you're someone that, gosh, maybe I'm on the edge of that, I don't know if it's really the best option. Even if you went into Google and typed in pre-tax versus post-tax retirement calculator or Roth versus pre-tax retirement calculator, there are all sorts of tools online where you can put in your information, your age, how much you've saved, how much you're saving, and it will calculate it out and let you know which is the better benefit for you.
Based on current tax rates.
Based on current tax rates, yeah. And that's the X, that's the variable, is we don't know what future tax rates are going to be. Yes, sir.
Do you have, for the Roth, do you have the same investment plans as you do for the 401?
So basically what, as I mentioned, under like funds by source, it will have your pre-tax contributions, post-tax, match, profit sharing. All of those are broken out, but the total assets are allocated, put in one investment allocation. So you don't have to pick different strategies for each one. It's all done in one investment allocation. And if you do choose to leave the company, the dollars have to remain segregated. So if you were to roll it into an IRA, the pre-tax IRA, the pre-tax dollars will go in one IRA, the after-tax dollars will go into a Roth. So those dollars do have to stay segregated.
Okay. And what is the age for withdrawal in the Roth?
It's the same. So everything's the same as the 59.5, 70.5 for minimum distributions for RMDs. So everything just mirrors one another.
If you were to transfer from a 401k to a Roth, your funds in the 401k, what kind of fee is that?
You can't at this time switch from pre-tax to after-tax.
Through you guys.
The IRS doesn't have, right now, the IRS doesn't have provisions for that in a 401k. What they do have, there is an option for companies to adopt a provision, but the provision that's set out by the IRS right now is only for participants that are over 59.5. So most think, that's too late, and it's a huge tax bill because you have to pay the taxable income on the full balance. So for most, it doesn't make sense to adopt the provision because most people at 59.5 wouldn't want the tax consequences.
But you don't have to take it all out of the 401k at one time. You can take it out in chunks if you want, right? If you wanted to transfer it to a Roth.
Yeah, you could, but at this time the company doesn't have that provision. It's a it's a provision that's out there, but your company hasn't adopted it, just because so few people are even eligible for it, and very few people capitalize on it who are over 59.5. Now, like 5 years ago, the IRS allowed a one-time for IRAs to switch a pre-tax IRA to a post-tax IRA. And I did that only because the market was so far down 5 years ago, the value was down 30%, and then they allowed you 2 years to pay the taxes, which was a nice way to split up because it's a pretty significant bill, right? But at this time, we don't see any provisions in the pipeline for making that change. Is that a diplomatic answer? Sure. Good. Anything else on that? Okay, well, I'm just going to keep talking. Also in the packet is your performance report, and the performance report should look familiar to those of you who have been in the plan for some time. The performance report's updated on a monthly basis, and I know most of you receive this either via email or you see it posted on the boards. This lists all of the investments that are available to you in the plan. So all of the investment options are mutual funds. So I'm not sure how familiar everybody is with mutual funds, but mutual funds are really simple. Mutual funds are comprised of analysts and managers and researchers, and they get together and they put together a portfolio of stocks and bonds. And then investors like you and I can buy shares of the mutual fund. So if I buy one share of the mutual fund, I own fractional shares of all of the underlying investments. So you can see it provides an enormous amount of diversification for a little bit of money, because there's no way I could go out and buy all of those individual stocks on my own. You know, there's hundreds and in some cases almost 1,000 individual stocks in a mutual fund. So you get a lot of diversification for a little bit of money. You also really get the professional management of the fund. They're going out and doing the research and the analysis on the underlying investments on your behalf. Also, it really takes the emotion out of investing. And that seems like a bit of an oxymoron to talk about emotional investing, but it happens. We see people all the time holding on to stocks too long. I've done that, and I know I've told you guys in the past, I did that in the late 90s with Cisco. You know, I bought Cisco at $16, $17 a share, and it went to 40 and 60 and 80, and it was trading at $100 a share. Well, what did I do with it? When it hit $100 a share?
Kept that.
I kept it. And then it went down to 80. And what did I do at 80?
Kept it.
I bought more because I thought it was going to go back to 100, right? And I'd open my statements, I'm going to be rich, all these wonderful things. Well, that now it's trading like in the mid 30s. So I've still almost doubled my money, right? But why didn't I sell it at $100 a share? I got way too emotionally invested in it, right? So taking that emotion out of investing is really important, because these analysts and managers and researchers that are deciding what stocks and bonds to put in a portfolio, they'll have an analyst that says, oh, I'm the international telecom analyst and I found a great opportunity in Hong Kong. There's this telecom company. Here's all its valuations. It's trading at $12 a share, and I think we should buy 50,000 shares of it. Okay, great. What do you think the top market cap is? Well, it's trading at 12 now. I think the top's going to be 12.25 or 14.25. Okay, so when it hits 14.25, do you think they go, maybe it'll go to 15, maybe it'll go to 16, maybe it'll go to 20? No, they sell it and look for the next opportunity. So it really takes a lot of that emotion and this thing out of investing. So in your plan, as I mentioned, all of the investment options are mutual funds, and they're broken out by asset class. So asset class just means the way the mutual funds help you invest. So at the very top, you'll notice that all of these bars, on each bar is the name of the asset class. On the top it says emerging markets. Right below it, it says Oppenheimer Developing Markets. So the Oppenheimer Developing Markets is the emerging market mutual fund that you could select to invest in. To the right, you have the ticker. So if you want to geek out like me and type in the ticker symbol, you can find out all sorts of good information about that mutual fund. And then you have the year-to-date 1, 3, 5, and 10-year returns. Now, the year-to-date and the 1 are actual rates of return. The 3, 5, and 10 are the average annualized rates. So what that means specifically is on the year-to-date, if I had been in the Oppenheimer Developing Markets from January 1st until November 30th, which is the date on the performance report, my return would be 2.13. If I'd been in the fund 1 year, so 1 full calendar year, November to November, I'd be up 3.02. But the 3, 5, and 10 are the average annualized returns for each of the years of investment. So if I'd been in this fund for the last 3 years, my average annualized rate of return for each year of investment would be 8.82. So 1 year it could have been up 15%, 1 year 10%, and 1 year down 1%. So it's just taking that average annualization for each year. On the very far end is the expense ratio, and the expense ratio is the internal expense of the mutual fund. So paying those analysts and managers and researchers. The expense ratios are automatically taken out of the returns. So the returns that you see on the performance report are net those expense ratios. So these returns are your true rates of return. You'll notice that the expense ratios vary from fund to fund. Some funds inherently cost more to manage than others. But that's something as your advisor, we're monitoring on a regular basis, making sure that the plan has fair expense ratios, and we benchmark that to other funds that are similar. So on your performance report, the top 3 options are your 3 international choices. You have emerging markets, international, and global. Those kind of all sound the same, don't they? But they are different. So emerging markets, I know we've talked about this in the past, but I would think of international investing segregated in 2 areas. You have international developed and international emerging. So international developed means that they're investing in international developed countries. What's an international developed country?
Sweden.
Sweden. Is that the first one that comes out, is Sweden? Yes, Sweden is an international developed country. I like that. Most of Europe, sans probably Spain and Greece and Portugal, but Canada, Australia, Japan, countries that have geopolitical stability, currency stability. Within those countries, they're investing in companies that have a history of revenue and performance and returns. On the flip side, you have international emerging, which is primarily made up of the BRIC countries, which is Brazil, Russia, India, China, and then other underdeveloped countries. So if you look at your performance report under emerging markets, Oppenheimer Developing Markets invest just in emerging markets. The international invest 80% developed, 20% emerging. And then under global, anytime you see the word global, that means they invest internationally, but they can have some US investments as well. So in this case, the American Funds New Perspective, they invest about 80% international developed, the other 20% is split between emerging markets and US funds. In gray, these are your core US funds. So all of these mutual funds in the US are actively managed with the exception of a couple index funds. And index funds are a little bit different than the traditional mutual fund we were talking about. So we were talking about mutual funds that have analysts and managers and researchers that are making the decision for the portfolio. In this case, if you look at like the large company index, it's the second from the bottom in gray. It says Vanguard 500 index. The Vanguard 500 index just invests in the same thing as the S&P 500, so the Standard & Poor's 500. So they're not taking any bets. There's no research or analysis or anything like that. They're just investing in the exact same thing as the S&P 500. Some people love index funds because, hey, it's great. It's investing in the same thing as the S&P 500. And look at the expense ratio. It's 5 basis points. It's super, super cheap, right? Because it doesn't take a lot of brain power or expense to just copy the index. But some people don't like index funds because, well, it's only invested in the S&P 500 and it's not actively managed. But you do have both choices in your plan. In green, these are your bond and income funds. You have a global bond fund. So anytime you see the word global, that means it's international, but they have some US holdings. Your diversified bond fund, a government bond fund, and then a stable value. If I were to say the most questions I get about these funds are always about the stable value fund. The stable value fund is in your plan in lieu of a money market account. So instead of having a money market account, we put in the stable value fund. Because we know money markets right now are paying a lot of zeros, right? 0.001, 003, right? So really, if you were to invest in a money market account, you're actually going backwards because you're not even staying on par with inflation. Inflation's 2.1, if you're getting a 0% return, you're actually losing about 2.1% per year. So with this stable value fund, we're able to at least get you 1.5, sometimes 2% without exposing you to more risk than what a money market would offer. So basically what a stable value fund is it's a pool of the highest grade bond fund options that have what we call a multiple wrap or a wrapper, meaning that an insurance company has wrapped the investment with a policy saying that if there are any losses, we are insuring it against losses. So if sky falls, everything goes to pot, then the worst case scenario as far as an investment in a stable value fund is a 0% return because the insurance company's insuring it from losses. Okay. And then in red, you also have a real estate, which is a REIT, a real estate investment trust. If you want to have a little bit more sector diversification, you can add a little real estate to your portfolio. But basically, the way your plan's set up is you can pick investments one of two ways. You can either select individual mutual funds on your own. Hey, I love this stuff. I have a passion for it. I'll pick 5% here and 10% here, and I'll go online every quarter and check it. And once a year, I'll rebalance it, and I open my statements. If you're someone like that, yeah, pick the funds on your own and manage it yourself. You certainly can do that. But we know that most people don't have the time or the passion for it. So you can, in blue, go under the managed portfolio strategies. You have the most aggressive, moderately aggressive, moderate, and conservative. You can pick one of the four, allocate 100% to it. It's managed and diversified and rebalanced for you using the funds that are already in the plan, right? So if you look under most aggressive portfolio, right underneath it, it says Oppenheimer Developing Markets 5%. Well, that should sound familiar. That's the emerging market fund that's listed above. And the American Fund Zero Pacific 20%. Well, that's that international fund that's there. So you know exactly what the underlying funds are. You know what percentage is going to each. And most important is that there's no extra cost or management fee to use the managed portfolios. It's the exact same expense ratio as if you pick the funds on your own. So I think, I come out once a year, and I do think it's a timely time. Go online and check to see where you're allocated. And I know a lot of times people will pick it and not think about it for years, but take a couple minutes, see where you're allocated, and hey, I'm not sure why I did this, then call me, call one of my team members, and we can, and sometimes it just takes a minute or two to go through it and make sure that you're invested appropriately. Okay? Oh my God, I've been doing a lot of talking. Questions?
Yeah. What would you suggest for a younger person to invest in a portfolio?
Yeah. So
for long term,
Right. So these are based on your age and your risk tolerance, or the number of years you have until you retire and your risk tolerance, right? So the most aggressive portfolio is for investors who are 10 or more years from retirement with a healthy risk tolerance, meaning, hey, I know markets are cyclical. I know they're going to go up and down, and I know I have 30 years until I retire, and down markets aren't bad things for young investors, right? Because in a down market, it stinks opening your statement and seeing a negative number. What that means is things are undervalued and on sale, and you can buy more for your dollar than you were able to before. And if you're someone that understands those principles and you have 10 or more years until you retire, the most aggressive portfolio would be most appropriate. The moderately aggressive portfolio basically adds 20% bonds to the portfolio. So that's for someone who's maybe 5 to 10 years from retirement, or maybe has a little bit of a lower risk tolerance and wants to add a little bonds to the portfolio. The moderate is for someone who's less than 5 years from retiring, and the conservative is for someone who's on the cusp or an active retirement, or maybe has really, really low risk tolerance. But I think that risk tolerance is easy to be willing to take risk when the market's up, but it's important to think about, okay, if the market was down 20 or 30%, how am I going to react when I see that negative on my statement? And I think a lot of times people don't understand what the negative means. I get phone calls when the market's down, oh, I'm bleeding money, I'm losing money like crazy. Well, the negative on your statement means that it's the difference in the cost per share. So if, let's say, oh my gosh, I swear I'm going to break my leg. I swear I'm not usually this clumsy either. So if I buy a mutual fund at $25 a share and it goes down to $15 a share, the negative I'm going to see on my statement is in the difference of the cost per share. So it's $100 per share. That's the negative that I'm going to see on my statement. I don't own any less shares, just the value of the shares have gone down. But let's say every pay period I put $100 in, right? So when I'm putting $100 in at $25 a share, I'm only buying 4 shares for every contribution that I make. But when the market's down and it's trading at $15 a share, I can buy almost twice as many shares as I was able to when the market was up. So when the market does rebound and comes back up, not only do you see this gain come back, but oh boy, I own over twice as many shares as I did before. So we want market cycles, especially for younger investors, because if the market was always going up, you'd always be paying more and more and more per share. And I cannot tell you any other industry when things are on sale and undervalued, people freak out, right? I mean, I think if REI was having a 50% off sale, most of us would be camped out and ready to buy everything 50% off. But if they were having like a 200% markup sale, well, you would go shop somewhere else, right? Well, in this industry, it's marked up 200%. That's what everyone's talking about. I'm gonna be rich, I'm putting more money in, which that's really the worst time to be putting money in because you don't have as much buying power as you do when the market's down. So we do have market cycles. We are going to have another market cycle. It's going to happen. Though most analysts, and myself included, think that we're in a pretty nice bull market. Most bull markets are about 8 to 16 years long. We're a couple years into it, and there are some indicators for that. One of the things that's a little bit unique with this bull market, though, is typically when you come out of a market decline, the recovery is a bit more sharp than what we've had. Our recovery's been a little bit more like this instead of this. And the reason for that is investors are weary. In the last 10 years, we've gone through 2 of the 5 worst market periods in history. So investors are a little bit weary. Companies have a lot of cash. They're sitting on the fence as well. But there are some good signs. Typically, in a good bull market, you have a nice spread in the yield curve. And now I'm really going to nerd out here. But the spread in the yield curve is the difference between the short-term and long-term rates. Every single time that we have gone into a bear market, the yield curve is flattened and inverted, where there's more demand for short-term versus long-term dollars. And we haven't seen that happen. The PE ratios are around 14, which still looks good. And, we do think that, there are some things that could constrict it, geopolitical issues, this oil issue, things of that nature. But most think that we still have some legs on this nice bull market.
So as far as, your little diagram
I'm sorry, I didn't even answer your question.
No, you're fine. So you're saying it's kind of a win-win here because, it goes down, you get more shares for your buck, goes up, you have more shares you just paid for
Yeah, you
half
dropped your
price.
cost basis.
All right. So it's just kind of about timing when you sell out.
Well, but you really, market timing doesn't work because we don't know, and there's the way that information comes in and out now. Even if you knew, mutual funds just trade a day and then trade once a day, and that's at the market close. So even if I had information at 10 a.m. that I need to sell all my international today, even if you sent in a trade at 10 a.m., it's not going to execute till 1 p.m. when the market closes. So the nice thing about using those managed portfolios is they're really well diversified. So if large caps doing well and small caps lagging, you have a little bit of both, and you have some growth and value in international and U.S. But trying to market time in and out doesn't work very well. But what you can do is just stay the course and not try to time the market too much. And what I do hear a lot is people will say when the market's down, well, I'm just going to sell everything, and when it gets better, I'll buy it back. So you're going to buy it at 25, sell it at 15, and buy it back at 25? That doesn't make sense. So one of the things that you can do when the market does come down, if you are wary and you think, oh gosh, you know what, I just really feel bad about putting more money in, keep your existing balances where they are, and then you can take any future contributions and put it into something a little bit more conservative or less risky if you don't have the risk tolerance for continuing to invest when the market's down. But if you understand the principle of dropping my cost basis, I'm buying more shares per dollar, I'm doing my dollar cost averaging when the market's down, that's where people really build wealth and make money in their plans.
Brooke, we have a lot of new people here at Western Towboat. Could you explain what their options are for getting some consultations and help?
Yeah,
get
so
started?
that's actually the next thing we're going to talk about. Any other questions on this before we go on?
Is there any restrictions or guidelines as far as changing the portfolios, trading money from different stocks and bonds, how many times you do a year?
Yeah. So the question was, can you overtrade in these accounts? If you hit so many trades, will you be charged a fee or something like that? The answer is yes and no. So the reason is that you know, you have access 24/7, you can make trades at any time without
on the
incurring,
website.
any expenses that way. But, there are some funds that have short-term redemption fees. So what that means is if you buy, sell, or sell, buy, sell the same fund within 30 days, it might trigger a short-term redemption fee. And I'm looking at this real quick, and the only one I see on there is Delaware Small Cap. And then maybe Columbia, I need to check with Columbia. But if you were to overtrade the Delaware, if you were to execute those 3 trades in a 30-day period, a little box would pop up on the screen that says, if you execute this trade, you'll be charged a short-term redemption fee for overtrading in your retirement account.
What's the fee based on? Is it based on,
A percentage, you know, usually it's like 15 to 25 basis points. It's not a lot, but most people, there's only one fund that I can see that's in there, and most people don't overtrade those individual mutual funds, but that's the only caveat. Any other questions? You're gonna do high trading volumes? Just asking. On the last page of the packet, it has tools you use to access your account. This includes the website, which is the 401save.com. To access the website, you need your social and your PIN number. If you don't know your PIN number, you can call this 888 number. The record keeper who's responsible for the website is just located up in Mill Creek, Washington. You can call them, hey, this is my name, I work at Western Towboat, I need my PIN number. And they'll ask you some security questions, and they'll either give it to you over the phone or they'll reset it for you. I do think it's important though to talk about, there are a lot of sources that are available to help you, and the record keeper is definitely one of them. They're a great resource to help you navigate the website and answer any administrative questions. Things like questions about the statement or the website, or loan policy, distributions, rollovers, things of that nature. Again, this is their toll-free number. If you call, you can speak to a live person, which how fabulous is that to speak to a live person, and they can answer those questions. If you have any investment-related questions, I'm not sure if I've allocated correctly, I'm not sure if I'm saving enough, I'd love to talk about an income plan for when I retire. That's something that we can help you with. It is complimentary. It's part of the service of being a participant in the plan. Our contact information is on the back side of the packet, and we're just located in downtown Seattle. So you can call and ask for me or talk to one of our team members. I do have my cards. I know a lot of times when you guys are gone, I get emails from you guys. You can email or call, whatever is the easiest way to connect.
What's the process of switching, from aggressive to moderately aggressive,
Yeah, so it's done on the website. So if you go to the website, you log in with your social and your password, and it comes up to just a summary screen. And on the top left, it says transfer funds, and you can transfer either your existing balances and or your future contributions. And it will list all of the funds that are available, the percentage you have in each, and then like a little empty box, you'd put in the amount that you want to move over, hit submit, confirm, and then you receive a confirmation PIN, and it's executed at 1 p.m. But I will say that it does take a little bit of time for the trade settlement because it has to go through the trust company, or the custodian. So it trades at 1 p.m., but if you go look on the website at 1:15, you're not going to see the settlement. But if you go back by 4:30, you'll see the settlement for the 1 p.m. trade.